The S&P 500 has been absolutely fire this year, and a lot of the gains that we're seeing have not come from those really large tech companies, which is great to see. In today's video, I want to drive down and really drill down to what the S&P is going to look like for this fall, even going into Q4 of 2024. So let's go ahead and break into this. So looking at the beginning of 2024, majority of the indexes were having a very narrow range, meaning in that first quarter, it was tech, more tech, heavy tech, artificial intelligence. Everybody was buying the exact same thing. But when you think of yesterday, which closed out quarter three with the end of September getting into October, let's see exactly how this has changed. Now, this is from an article on the State Street, and I definitely want to cover this because when it comes to the S&P 500, even looking in Warren Buffett's forecast, 90% of people should be invested in the S&P 500, which is kind of crazy. So when we think about this, for a year to date, tech is still the leader, but not really as much as people think. It is up 29.6%. When you're thinking of the S&P itself, it is up about 20%. Even looking at some of the biggest drivers like Nvidia, it seems like it soared very early with the promise of artificial intelligence and also those big semiconductors and sort of kind of leveled out. Now, when we think of the Federal Reserve doing that 50 basis points cut, made a big difference. And of course, that made a big difference in a lot of different places outside of tech when it comes to the growth factor. There are two things really to remember that are going on in the news today. Number one is the port strike. Now, they have said that 46% of all imports come through the ports, which are on the East Coast and also the Gulf, that are on strike. As of right now, we don't know exactly what that's going to look like, but that could affect some big businesses. And the threatening of really the broadening war of Middle East already been kind of warned if you checked out some sources that gasoline prices could absolutely skyrocket. But when we look at today, it was another record day, which is kind of crazy. But those tech stocks have kind of price to earning ratios have leveled up. Now, when we think of Nvidia alone, up 82% in the first quarter, but still up 145% this year, which again is kind of crazy. But when you think of the profits and the money this company is really bringing in, it's insane to think. The shares fell 1.7% thanks to part 5% in July. So we did see a little bit of pullback like we were saying with tech, but the S&P right now finished the quarter 20.8% up year to date. And it was the biggest gain through the third quarter of the year since 1997. So, I mean, we're going back almost 30 years with this big gain that we're seeing in the S&P 500. Now, when we start thinking third quarter and just thinking of our last 3 months, overall dominance was utility stocks. Again, I love to see this and I love the versatility. I love the risk mitigation of all the different sectors because utilities were rocking and rolling. Utility sectors was up 18.5% for the quarter, 6.4% in September alone. And of course, with that 50 basis points reduction with the Fed, real estate stocks rose 16.3%. So we are seeing a massive push of utilities and of course the real estate. Then when you couple it with all of the tech growth that we've already seen, tech, a lot of people are saying are overbought. They're saying it's wildly overbought. The price to earnings ratio don't make a difference. But when you start looking at some of the top performers within the utility companies and really some of the energy companies, they are doing incredibly well. They even note in here utilities Vistra, which is VST, up 38.8% on the quarter. Constellation up 32%. Some of the top performers in September alone, kind of crazy. Now the laggards are the ones that are really pulling it down are the oil and gas producers. So there's a couple in here, including Dollar Tree was noted, that is really bringing it down. But when you start looking at some of the Home Depots, Caterpillar's up 10%, 9.8%. But looking at Boeing, of course, with those safety issues, down 12%, JP Morgan Chase down 6.2%. So a lot of up and downs. Now, of course, recession worries grow, then ease. So we're seeing a lot more in a little bit more of a step towards a possible recession. The economy was giving off noise that we could be looking at a recession in the future, but with so much money leaving tech stocks, and this is where it's kind of happening. And that is why we're not seeing again in Q2 and Q3, we are not seeing the massive buildup in the accumulation of tech stocks. Is a lot of money were pulled out of these overvalued tech stocks. They were moved into a bunch of other things with stocks with a lower P&E ratio, which again, when you look at tech stocks and the price and earning ratios, it goes kind of crazy. And investors look at a lot more favorable stocks, even thinking of things that are dividend paying. Even we have seen a big rise in a lot of the dividend paying stocks and the yield, more of the stability. The S&P tech sector was up 1.44% in the quarter, 2.54% in September. So of course, the quarterly performance was the third worst 11 of the 11 sectors. And of course, this is pulling money out of those big tech companies. Now, when we think of looking at really September and this third quarter, there are some of these sectors that are doing very well. Looking at utilities, again, for the quarter, up 18.46%. When you look at consumer discretionary spending, 7.6%. Communication services, 1.4%. So a little increase there. Real estate, again, 16.3%. Massive increase in the real estate sector. Even looking at some of the consumer staples, 8.2. Financials, 10.2. Very interesting to see that financials for the quarter were up 10.2 when JP Morgan Chase, one of the biggest contributors, was down considerably. Healthcare, 5.6. Energy, 3.12. So again, when you start looking at the quarter, it was not driven by tech. Tech was actually up 1.44, with the IT sector only a 1.44% growth. Again, thinking of what we see in the dominance in quarter one, definitely making some move within that S&P 500. So year to date, this is where we really tally it up. IT still running it, 29%. So if you are heavily invested in those tech ETFs, which I personally love to hold, you would be up roughly 30%. Now, when you look at communication services, 27.8. So literally right there, almost hand in hand with tech, again, leading to this big performance of the S&P. Utilities up 24.5%. This is also kind of the controversy that we've seen if you're in the political front, with a lot of the utility companies kind of overcharging consumers and really price gouging. I know that's a thing that a lot of people have said about when you're looking at like discretionary or staples, things of that. Even consumer staples up 16.5%, industrials 19%, consumer discretionary 13.21, and it just goes on and on. Healthcare 12.9, materials 12.5. We have real estate up 11.4, and energy up 5. So when you think of all of the sectors that we have within the S&P 500, they are up, and this is the reason why. You combine, information technology, communication, utilities, and financials. Those are all four sectors that are up 20% or greater on the year, which is just absolutely phenomenal to see. Now, of course, the S&P 500 doesn't always run like this. We don't see, an absolute banner year like this all the time. But for me personally, I do invest heavily into that S&P 500. Even thinking of my portfolio itself, my 401k portfolio, went through a bunch of different things, went through some tech stocks. But overall, because you're really pigeonholed into what you can invest in, I invest in the S&P 500 in the entirety of a 401k portfolio. I do not choose to do international. Now, when it comes to the international market, it is something personally that I do not invest in. I feel like there are so many companies within the United States that are large enough. They are global. They are in pretty much every major market in the world, even some of the emerging markets. A lot of the large companies, and even thinking of the US economy itself, it is roughly 50% of the global economy. So when you take that into account, investing in something like this S&P 500 does incredibly well. And I really feel like over the next 3 months, we're going to see the continued growth as in what is driving this S&P 500. And again, I feel like we're in a really good place, especially because it is not driven all in its entirety 100% driven by the tech stocks. It is driven by everything else that we do see. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think about this S&P 500. And as always, thank you guys for watching.